Alright, so in the last 2 weeks, we've had two very massive buying signals for Tesla. So number one signal is a little bit of a Tesla specific situation. And the second signal is actually a little bit more of a macro driven thing. They're both super important, so we're going to break them down in this video. Alright, and to understand the first signal, we have to see why we're in the situation that we're currently right now. And Tesla has been dropping a lot since they actually released the delivery number for Q1. All this drop right here has been either inventories, then we got the results here, then all of this is margin and more margin repricing. So pretty much in the last month and a half, we've been dealing with a lot of margin repricing. And this is currently the biggest problem that we have for Tesla as a company and Tesla stock. And for whatever reason, we have to look at this chart. This is probably the most important chart that Wall Street pays attention to right now. And this is Tesla auto profits without credits. It's certainly a proxy from auto margins. And we can see that this actually has plateaued in the last, 6 quarters or so. And the stock peaked right here at the end of this trend in profits. To see it more clearly, we're gonna compare it with revenue. And if you see here, revenue has been increasing a ton, but the auto profits, as we saw from the previous chart, has been pretty stable. So how can a company be having this much growth in revenue and profits be so stagnant? Well, the reason for that is because even though revenue essentially is number of units times ASP, average selling price, and the profits are essentially just revenue times the margin, as Tesla has dropped all the average selling prices, that has affected margins as a consequence. And this became super obvious at the beginning of Q2 last year because revenue started accelerating. And if revenue accelerates and profits just stay stable, that goes against the operating leverage that Tesla has managed to build in the last couple of years. So it all comes back to average selling price and margins. But we had a couple of news in the last couple of weeks. So essentially in April 21st, Tesla actually hiked prices for the first time since the beginning of the year. And remember, we've had 6 price cuts since the beginning of this year. It didn't mean much, but we actually had a second price increase on May 2nd, which a couple of days ago. And this causes that the street now has to take this price increases seriously because it's not just an isolated incident, it's now more prevalent after 2 or 3 or 4 or whatever. And this is the first massive buying signal because it sort of fixes the problem that we've had for the last I don't know how many weeks with the margins. As you can see, the reason why the auto profits have been stable even though revenue has been increasing is because this drop in margins. And we've been talking about this chart extensively in this channel, but this trend lower is the worry for Wall Street. As the news come that Tesla's actually increasing prices now, we can probably see that this chart bottom in Q1 or perhaps in Q2. I'm not saying it will increase all of a sudden, but the street is actually accounting that this will be stable or relatively change in the upward direction. So it's a matter of anticipations for margins to actually be stable as opposed to just keep dropping and dropping and dropping. Now the second massive buying signal comes as a little bit of a macro driven, and this is the probability for Fed interest rates to actually stay in the current level right here. And as you can see, it's 91%. So the market is pricing in 91% certainty that the Fed is gonna pause interest rate hikes in the next meeting in June. Obviously, there's still a little possibility that the Fed might increase it at 25 basis points, but this is very low at about 8%. And obviously, we know how this affects stocks, but I'm talking more specifically for Tesla, the interest rates. Interest rates for car loans in the last, couple years, as you can see here, has been on a massive uptrend. And Tesla has been able to combat this a little bit with average selling prices, right? If they drop the prices, that sort of compensates for this massive increase in interest rates. But the moment this trend actually reverses and goes the other direction, that's going to be essentially the same as a price cut. It's a massive price cut for Tesla vehicles without affecting their bottom line. And the reason for that is because this price cut wouldn't actually touch ASP. Each car becomes more affordable to the regular consumer. So the moment car loan interest rates become stable or actually go down, it means the average selling price stays stable or even increases, which is going to help Tesla and they don't have to cut prices again. Now, obviously it's not all roses, but as we can see, we just fixed potentially the margin issue. With the interest rates reversing or just being stable, we essentially fix the affordability. And these are the two massive buying signals that I was talking about. Obviously, it's not all good. And I wanted to point your attention to something that happened the other day that I think could actually affect the business going forward. So there are rumors now on Twitter, especially by Troy, that they might pause the production in China because of a buildup in inventories. And right now, it seems like it's just a 5-day delay. But the problem is this could become more extensive. But if it's just 5 days, I'm not too worried about this. But this is something to take into account. It's not all all perfect for Tesla stock, but so far these two buying signals make me a lot more bullish in the short term. Anyway, thank you very much for watching, and I'll see you next time.